Good afternoon, and thank you for joining me. I'm Philippe de Lapérouse, Managing Director of HighQuest Partners. For those of you joining me live today on November 15th, I invite you to use the comment box at the bottom of your screen to submit your comments and questions. I'll share my thoughts on the outlook for ag investing over the next 15 minutes or so and then respond to your questions. Let's begin. HighQuest Partners is engaged in three different lines of business which provide support to the food and agricultural investing community on a global basis. We provide strategy, advisory services, which include market entry and due diligence services to investors and companies engaged in the industry. We also provide media products such as digital magazines and breaking news coverage. And we organize international events which bring together decision makers in the investment community. This includes our next installment of the Global Ag Investing Conference, a series which will take place in London this coming December 5th through 7th. At HighQuest, our focus is on upstream and midstream activities in the supply chain. As you can see, the upstream activities include inputs and services that go into the production of biomass, crops, as well as animal protein, livestock and aquaculture. And then in midstream activities cover storage and transportation, logistics, and then the primary and secondary processing of the production from the land that then are distributed through food, feed, and fuel channels downstream. And as you can see, our client base covers a wide range of both large and regional players in the industry, covering a number of different types of activities in this supply chain. Institutional investors have a wide range of options for where they invest in the industry. And as you can see here, this mirrors where HighQuest Partners has expertise on its consulting business. This includes inputs, farming, and processing. But increasingly, we're also seeing interest on the part of institutional investors in investing in ag tech, both as a sole exposure in terms of VC funds, but also as in combination with investments in other sectors of the supply chain, because it gives investors more understanding of what the profit drivers are and how to leverage new technologies to drive profitability and margins over the long term. A recurring theme since we launched the Global Ag Investing Conference Series in 2009 is whether agriculture is emerging as an asset class on its own, similar to the energy markets or other asset classes in industry and in the financial community. And what you can see here is that we've estimated that investments in farmland on a global basis ranges between 35 to 45 billion, which represents a very small percentage of the total investable universe of farmland, which of course is fragmented in terms of ownership, particularly when compared to timberland, where the institutional investor ownership penetration of ownership in timber is much higher. We think that institutional investment in farmland, particularly in the real asset class, is going to continue to grow despite what we've seen as flattening prices over the last 2 years because of lower commodity prices. And this really, we think, is a good sign that agriculture is becoming an asset class on its own merit. I think it's worthwhile just repeating or going back and understanding what is the thesis that has driven institutional capital into the ag sector, particularly when this trend started about 10 years ago. And we could see that supply and demand imbalances was one of the key drivers that led for increased demand for land to produce higher yields of commodities and animal protein. But also investing in farmland provides investors with an inflation hedge, a hedge against inflation, and wealth preservation, which is key, particularly in what can be viewed as a very volatile period that we've experienced over the past 10 years. And we see no reason why that should continue to abate going forward, particularly given political changes that we've witnessed over the past within the last 12 months. We also note that farmland investments in farmland provide low correlation to other asset classes, which I'll talk about a little further on. And then, as I just mentioned, it's an asset class that's under-owned by institutional investors, which provides an opportunity for those who are getting in at a fairly early stage in the sector. Of course, investors looking at the ag sector and food sector for the first time who haven't committed capital to the sector will ask the question, has the soft commodity sector, have we reached the end of the super commodity cycle? And in this chart, we compare the hard commodity prices to soft commodity prices. And as you can see, with the exception of the late to early 1980s, commodity prices for soft commodities, that is crops, have been much more steady and less volatile than the hard commodities. And we would argue that because of food security concerns, and combined with weather volatility, because crops rely on water and weather to ensure their production each year, we think that the opportunity in soft commodities is not the same as for hard commodities, and that the hard landing that we've seen over the last 2 years for hard commodities is not the same long-term story that's going to take place for soft commodities. Because of volatility in the weather, we think that there continues to be opportunities for investors that are well positioned and ready to pull the trigger and have done their homework. And we continue to think that there is risk out there. That means that there's going to continue to be a shortage going forward, despite the accident stats we've seen, that in the future we will see problems with supplying demand, meeting demand, and that creates opportunities for investors. This chart underscores the fact that climate change is going to have a major impact on yields and productivity going forward. As you can see here in Iowa, which is a primary growing, if not the best growing area for soybeans and corn, not only in the U.S., but in the world, the rainfall over the last 5 years has fallen outside the 95th percentile of 120 years of rainfall data. What this means is that we can no longer rely and predict based on time series of data going back over a century that certain areas of the world that have been well suited for growing crops will continue to be doing so. So this means there's going to be additional pressure on existing farmland that's in production to increase, or at least to maintain productivity, if not to increase, to meet growing demand for those products. As I mentioned before, the returns on farmland have exceeded the returns on other options that investors have in the financial markets, the paper markets, as well as timber. You can see that over the last 25 years, the NCREIF Farmland Index, which is a consolidation of institutionally owned farmland, has generated a higher return than other options that institutional investors have, with a lower standard deviation on those returns, so with lower volatility. This is an attractive aspect of an attribute of farmland investing, and this is one reason why we think that every portfolio should have some exposure and allocation to farmland. Here we see that Illinois cropland, which is used as a benchmark for the value of farmland, not only in the U.S. but in other parts of the world. You can see here that the nominal values of Illinois farmland at the end of 2015 were still below the capitalized valuation of the land based on the capitalized rents generated by land in Illinois. While crop prices have flattened out over the last 2 years across the Corn Belt, we still think that this provides an opportunity for investors to come in and invest at what are relatively low prices compared to the historical rise we saw over the past 5 to 10 years. But we still think it provides an opportunity for investors that want to have an exposure in this sector. I'd like to shift gears now and talk about deal activity in the financial community as it relates to agribusiness. As you can see here, in 2015, M&A deal activity accounted for 75% of the financial activity related to agribusiness, compared to investments, financings, and multilateral government investments and joint ventures. Not surprisingly, North America and food processing accounted for about quarters, 75% of M&A activity in 2015. Although you can see that there also has been activity in Europe as well as animal protein production. You can see here that Africa as a region, as well as investments in farmland and cropping and production of animal protein, attracted a sizable percentage of investments allocated to our agribusiness in 2015. As I mentioned earlier, emerging markets are expected to drive the growth in crop production and livestock production over the next 8 to 10 years. This is a theme that we can think is going to continue over the next 2 decades and creates opportunities for investors that are open to taking risk, but also with generating higher returns in some of these frontier markets. Agriculture, like any other industrial activity, has its own timeline in terms of its ability to adapt and accelerate with following the adoption of new technologies. In this case, this timeline is comparing the timeline for agriculture with the transportation industry. But as you can see, agriculture has made some major leaps over the 2,000 years depicted here. And I think it's a misunderstanding of agriculture to assume that it is hidebound and not able to adopt to changing environments and new technologies that have been developed in other areas of human activity. What is interesting to note is that the opportunity to leverage new hardware, in this case seed genetics, is also supported by the adoption of management techniques or software. While new seed genetics are a great improvement and have been a great improvement over the last 20 years, they will not function and generate the sort of increases in productivity that are desired unless management practices are also changed and adapted to fit circumstances. So this is one big area for opportunity in the ag sector, is to not only leverage new technologies, hardware, but also to new business models and new management practices to make sure that that hardware is well applied. Digitization and miniaturization are certainly accelerating change in agriculture. In terms of digitization, we can see here that that technology is being harnessed by producers, farmers across the world to monitor crops, to access pricing history, current prices to be able to engage in markets. To a certain extent, the adoption of digitization by farmers in emerging markets is outpacing the adoption in developed markets. And we also see that miniaturization is enabling producers to do things that they've never been able to accomplish before, in terms of having a better sense of what is going on in remote parts of their farmland parcels, and also in applying inputs, fertilizers, pesticides in hard-to-reach areas. So we've seen major changes in how farmers are operating today, and this is only going to continue into the future. Any misgivings that agriculture is unable to integrate new technologies should be dispelled by this chart that reflects the fact that GMO technology was adopted extremely rapidly with its launch in 1996, with the launch of Roundup Ready soybeans. But you can see that that adoption rate has also been quite steep for other genetically modified crops. In fact, the adoption of GMO soybeans is probably the fastest adoption of any new technology in any industry in history. You can see that it went from 0 to almost just short of 100%, 95% here in the United States and abroad. So this should dispel any concerns that agriculture isn't able and isn't capable of adopting and integrating technologies that provide real value and sustainable, differentiated capabilities to generate margins over the long term. To understand where the opportunities are for investing in ag tech, we monitor generic industry disruptors and the likely impact they're going to have on those areas, subsectors in agtech. That includes ubiquitous connectivity and sensors, autonomous robotics, gene sequencing and rapid phenotyping, data capture, aggregation, analytics, and prescriptions, novel materials, and innovative business models. So we really do think that it's important to understand the nature of those disruptors and how they will have an impact on those subsectors in agtech. Finally, I'd like to conclude with our sub-allocation framework for an ag portfolio, which we think summarizes the issues or decisions that an investor has to make depending on what his core objectives are in terms of risk, reward for allocating capital. And those three points are the geography that one would invest in, the type of asset one would invest in, and then the operational developmental model that would be used to put that capital to work. In this case, assuming an objective of 8 to 12% return on a core portfolio, one could conceive of investing in row crop land in North America, and that the owner of that land, the investor, would lease that land out to a producer for a cash lease. So he would be basically not taking direct ownership or responsibility for managing that land, but leasing it out for cash. Obviously, if an investor is looking at investing in a frontier market, in a direct operating kind of situation, let's say in animal protein production, where the investor is actually managing the process in a company, one would assume that the returns would be higher. I would now like to respond to some of the questions that have come in from viewers over the last couple of minutes. The first question up is how a Trump administration is likely to affect the ag sector in 2017. Well, I don't think that the Trump administration is going to have ag as a top priority, but there are two policy initiatives that it might undertake that could have an impact on agriculture, particularly on North American agriculture. One is if they decide, the new administration decides to pursue punitive tariffs on trading partners, which could result in retaliation, in which case, as the U.S. is a major exporter of grains, oilseeds and grains, and other commodity products, that might have a negative impact on exports. Another area where there may be an impact on agriculture is if there is a major clampdown on illegal immigration. That could impact the collection of food at harvest, particularly permanent crops out in the western states, California, which could have a major impact on food prices, could dramatically increase food prices. So those are the two areas where I think a new Trump administration might have an impact on agriculture. The next question is, what do you think Brexit means for ag profitability in the UK and in Europe? I think the Brexit has already had a rather negative impact on farmland values in the UK. It's put pressure on the values of farmland. There's been decreased interest in investing in farmland in the UK. I don't know that it would have the same impact on Europe, but I do think that Brexit might end up causing result in an increase in prices for food commodities, which would be a political cause political concerns in Europe. And I think that in the UK, food prices are definitely going to rise because the UK is a major importer of a lot of food products. Next question is, how will political change or the upheaval that we're currently seeing in the Western world influence the ag market over time? Well, I think like any industry, agriculture is going to be subject to some of the vicissitudes of that upheaval. Increased nationalism, closing of borders, focusing on promoting domestic production, and probably setting up trade barriers. So I think that while that does raises risk for the sector, I think that there are ways of mitigating those risks, and I think that the canny and savvy investor should be able to address those without too much trouble going forward. I think we need to remember that food is a basic necessity, and also with all this upheaval, a lot of governments are going to be very reluctant to not ensure that their populations have access to sufficient quantities of good quality food. And I guess I'll take this as the last question, which is submitted in two parts. The question states that mergers and acquisitions have been quite prevalent over the last couple of years, particularly in the ag sector, and that we've seen consolidation now with Monsanto being acquired by Bayer, Syngenta by ChemChina, and the merging of Dow and DuPont's ag businesses. So do you expect this merger activity to continue? That's one question. And then do you think American investors, US-based investors, underestimate or overlook opportunities in Europe in the food sector? As to the first question, I do think that regulators are going to take a hard look at some of these acquisitions because of concerns over consolidation. I do think that Monsanto and Bayer will get a thorough vetting by regulators, not only here in the US, but also in Europe. And I do expect that that will result in some divestitures on the part of both parties in order to ensure that the merger is concluded. ChemChina and Syngenta, there may be similar concerns. I see less problems with the Dow-DuPont combination simply because of the complementarity of those businesses. I don't think there's too much duplication in assets, so I think there's less chance that there will be a major need for them to divest of brands or companies or operations. In terms of U.S. investors having opportunities in Europe, I think it all has to do, obviously it will have to do with the relative value of the dollar, and we'll see going forward with the markets, particularly as the Fed reconsiders the interest rates over the next month or two, particularly with the incoming new administration, whether a U.S. dollar will will be able to buy more. I think there probably are opportunities for U.S. investors in Europe, particularly in the food and agribusiness sector. Not so much in the agribusiness, but in the value-added food sector. So with that, I thank you very much, and I welcome you all to our upcoming London event, where I hope to see you, and look forward to reconnecting in future webinars on other topics in the next year. Thanks very much.